2 hours. We must have spent 2 hours when we are doing this. So, irrespective of the level of activity, this principle remains the same. It doesn't change. It doesn't change. This principle remains the same. It doesn't change. Fixed cost is fixed cost, and it is fixed. No matter the story they give you, just follow the principle. Separate the cost. Get your variable cost. Apply it to the level of activity. Then get your fixed cost and let it be fixed. And it's always given in total. I told you guys, it's given in total. It's not that unitized, except when you want to do absorption. You want to absorb it. Then you will not get your overhead absorption rate. Not even unit. Overhead absorption rate. You use the total divided by the level of activity to get your overhead absorption rate. This will not absorb the other level of activity. That is where you deal with absorption rate. Yes. Continue.
The fixed cost we get from the selling and admin overhead, are we going to add it with the 500 naira per quarter?
No. That's what I'm saying. That 500 per quarter is It's irrelevant.
Why? Why, sir?
Because it is already in that fixed cost you got using high and low method. What is your fixed cost? Calculate your fixed cost by using high and low method. Calculate your fixed cost using high and low method. Calculate your fixed cost. What do you have? You have 1/8. I mean, what's the 1/8 and 1/2? Is that also? Selling 1/8 and 1/2. One 8 and 1/2. Then what's the cost? 1/8. 1/8. 73. 73.
The variable there is
1/2
is 6,700.
6,700. 600. That's 600. Unit of assembly is 600 plus 600. It is 1 naira. Substitute in 1 above. In equation 1, substitute equation 1. That will be 73 equals to A plus B. B is what? B 8 times 1. That will be 7,300 minus 1,800 equals 8. That will give us 5, which is equal to 8. So A is 5,500 naira. So this will be your fixed cost, irrespective of level of activity. while the variable cost will be multiplied by 1. So that 500 they talk about is actually in that 5,500 you calculated. That's what they are trying to say. So the way you interpret your question is very, very important too. But what I will advise is that if any assumption you make, if you are not sure that you are correct in the example, what do? State your assumptions. At least for stating it alone, it shows that you know what you are doing, even though you are doing the wrong thing, but you know what you are doing. You know you have to state your assumptions. Don't just write. It is not enough for you to write your solution. Even when you are sure that what you are doing will be different from the real solutions assumption. But when you state it, they will look at it in your own light too. And say, if we agree that this fixed cost, state it that you took selling and admin as fixed cost, though that you know it could also be a variable cost, but you took it as fixed cost. They will mark you right because you stated the assumption. That is the reason why you will come down and state your assumption and tell it your assumption in red by rule and say, I assume that selling an admin cost, the total cost or the cost per question as the fixed cost.
So I have a question.
Even when you are stating that many times, you will now remember that many times when your level of activity is given, you should watch out for those fixed costs. There are always an element of variable, at least 2 or 3 level of activities. There must be an element of variable cost. You have to use high and low method, extract it from the fixed cost. Simple.
So I have a question.
Okay.
I think one of the things that was tripping me up in this question was that the sales and production different units were given. Now in the question for the first to third quarter, the production is 1,200, 1,500, and 1,800. Now and then in the required, they now say the sales is ranging from 2,000 to 2,500. So if when we are calculating the calculations we are calculating to get the variable cost, we are using the production to do the high and low. Then when we now come to the fourth quarter, we are now using the sales. I think that is what was tripping me up in the question, why I was using different values to do my calculation. I think I focused on sales and not on production, but I think I also picked production in some. So can you clarify that part, please?
Now, the question you are giving me is that why not give the same value or units for production and sales? No. That question
Not necessarily. Not necessarily.
is wrong.
No, that's not what I'm asking. What I'm saying is that when we are doing the calculation, we use the production level of activities. Now, when we now want to do for fourth quarter, we now jump to sales.
Now, the fourth quarter, the fourth quarter for sales and production, the level of activity is equal. If you watch the question, he said prepared festival budget figure for the fourth quarter showing sales, costs, and profit figures, assuming sales and production, that is, sales and production is equal in the fourth quarter. They sold 2,000. They produced 2,000. Fourth quarter, number 4. The fourth quarter, the question was explicit. It was not ambiguous at all. It told you what the sales and production. So you need to be very careful as you are interpreting. Don't bring the ones. That's why I asked you to read the required first, so that you will understand what they say. When you now go and start doing your workings and you see a different figure for first quarter, second quarter, and third quarter for sales and production, assume that is the way it was for first, second, and third. But it is not the same for fourth. Fourth, the sales and production are equal. You see, have I been able to clarify it? You will see that the question itself was explicit. It said the sales and the productions are equal. But your first quarter.
Okay, what happened is that I didn't know that there was a continuation of the question, so I didn't read this part. So even these customers are allowed 2 months credit period, blah blah blah. I didn't see that part before. I think that's what happened. All right, thank you. You can answer my question.
Budget always in total. Standard is always per unit. So it is always important to set a standard for yourself based on your capacity. A unit price planned for the future or ahead. Just like that's why both of them are for control. For management control. We have different standard. We have basic standard. We have ideal standard. We have current standard. We have attainable standard. This standard cost that remain unaltered, that is, doesn't change over a long period of time. It doesn't change easily over a long period of time. And this might become outdated due to change in technology, in laws, in norms, principles. It can only help us, basic standard can, to express changes in efficiency or performance over a period of time. That is basic standard. Now, ideal standard is based on perfect working condition. And what is perfect working condition? There's no wastage. Inefficiencies. No breakdown of machines, etc. And one of is that I didn't encourage startups. That is to say that there won't be a breakdown of machine. Agreed. But you need to stop production sometimes to service your machines. Even if it didn't break down, you won't wait until it breaks down. Because if it does, you would lose a lot of money. You will lose production. You will lose production. So losing production means losing fund. Idle time, staff gets tired, they go to the toilet. They go to ease themselves. That time they use in easing themselves, it's an idle time. You will pay for it. You pay for it. So there's nothing like ideal per se. What of if you have work to do, union, strikes? Your ideal standard will break down. Then we have current standard. They are based on current condition of service or current production. Example is current losses, current inefficiencies, etc. Then attainable standard or expected standard. Attainable or expected standard. This standard is a function of normal operating circumstances. It gives allowances for losses, wastages, inadequacies, inefficiencies, etc. It makes up or having deficiencies. It helps them to adjust their psychological cue that knowing that they will have losses, they will have wastages. It gives allowance, even though going to be tight. But in looking at the allowances, management can set up a control in order to reduce such inefficiencies, deficiencies, wastages, and losses. And that is why standard cost is a control cost. Now, from all these things that I've told you, you can get their merits and merits. You can extract the merits and merits from them. We are looking at operating variance, because when you set a standard and the performance starts coming out, you realize that the standard you set might be different from the actual performance. And because standard is always fixed for a long time, it's not easy to flex like flexible budget. It's not easy to flex like flexible budget. It's always fixed for a long time before you can change it. So you will see that the effect when it is unfavorable is always adverse. That is on the extreme of unfavorable. But when it is favorable, it's favorable. When it is on the unfavorable part, it will be on the extreme side. And that is why we need adverse for standard costing and unfavorable for budget, because we can flex the budget, but it will be difficult to flex the standard. So what are the operating profit variance? So when you compare the standard with the actual, it's either you have favorable or you have adverse effect. So this difference, we have to look at it under the various classification of cost and sales. The various classification of cost and sales. For our examination post and for management accountant, we will stop at the ordinary variance, which is just sales and the cost. That is the fixed cost, the variable cost, the sales. But for those in the performance management class, we will take the advance of it, which under sales, you have the sales mix variance, you have the sales quantity variance. Under cost, you have particularly under fixed production cost, we have the advance of them and other variances that we need to calculate and look at. That is for advanced variance. But for the foundation level, we'll stop at the ordinary variances and how it affects our profits. Because many a time, standard costs lead to absorption of costs. Lead to absorption of costs. So when we absorb in production, there's always a difference with that of financial accountant. Because the financial accountant deals with actual cost, actual sales. That is what the financial accountant deals with. Actual cost. But the management accountant has gone into production using the standard cost, and there is always a difference between the profit of the accountant and the profit of the who of the management accountant. So it will lead us to reconciling that two accounts. So let's look at the various variants we have. I want to chart it on the board. I want you to write it out so that you can absorb it into your formula pattern and keep it there for say is divided into sales and cost. Sales variance. Now that is how your operating profit looks like. The cost variances. If you look at your financial account or operating profit account, you will notice that it's divided into sales and cost, variable cost, fixed cost. Okay. So our sales variance is also divided into two. That is sales volume and sales price or price variance. What's it? Now, the volume divided into two. Mix sales sales variance and sales quantity variance. Sales mix variance and sales quantity variance. Like I said before, variance can be divided into three. I have the selling and admin variance. Selling and admin and distribution variance. The variable production cost production cost. Many a time, must separated into variable and fixed. The second admin and the structures are always semi-variable for the fixed cost. So this variable profit must have gone to the variable production cost. Must have gone to the variable production cost. Now, so but now we can look at cost, which can be divided into three. Divided into direct material, direct available. So we have material direct labor and variable direct material, direct labor and variable overhead. Available. Now, under direct material, which can be divided into two, can be divided into two. We have usage variance. That usage, then we have price. Direct material variance. And we have usage variance. That is divided into three. Divided into three. We have the efficiency variance. We have idle time variance. Then we have the price, which is wage rate variance or rate variance. The advance of the is under the advance variance is under usage, and that is divided into two, which are the mixed variance, the mixed cost, the mixed direct material variance, and the yield. The yield. Because sometimes what you mix, not what you yield. If you remember when we were doing one of the topics, I think it's budget. We talked about yield in the question. We talk about yield in the question. What you mix and what you actually yield. What you mixed and what you actually yield. For us.
Okay.
You are
Required.
required.
Prepare prepare an operating what is this thing shaking? Yes, prepare an operating statement reconciling the budgeted profits with the actual profits. All closing stocks are valued at standard cost. B. An explanation of all the possible interdependencies between the variances. Go back to the next one. Dapo Limited produces thatch roofs for houses. The budget for 2006 was as follows: number of houses to be thatched, 140 roofs. Revenue, 6,000. Standard cost per roof, direct materials, thatched 2 tons at 400 naira per ton, 800. Other materials, 300. Direct labor hours, 300 hours at 5 naira, which equals to 1,500. Variable overhead, variable production overhead, 300 hours at 1 naira each, which is 300. Fixed production overhead, 300 hours at 7 naira each, which is 2,100. Standard cost, 5,000. Standard profits, 1,000. Note: the budgeted fixed production overhead was 147,000, which from which the standard absorption rate of 294,000 over 140 times 300 hours equals to 7 naira per hour was derived. Since one thatched roof equals 300 standard hours of output, the fixed overhead cost per roof equals 300 standard hours, which equals 2,100. There is additional budgeted overhead for selling and administration of 30,000 naira. The expenditure is regarded as fixed cost. Actual results in 2006 are as follows: number of thatched roofs, 150 roofs. Revenue, selling price per roof, 5,700, which is equal to 864,000. Thatch. Thatch
Continue from
purchases 360 ton for the cost, which is equal to 133,200. Used 340 tons. Other direct materials 48,000. Direct labor per hour. Direct labor in hours 52,000. Hours worked, active time 44,000 hours. Hours of idle time is 8,000 hours. Cost of labor, cost of hours paid for 288,000. Variable overhead 46,000. Fixed overhead 304,000. Sales and admin overhead 32,000.
32,000.
I'm done reading.
Now this is the actual performance that is given to us. The actual result, number of roof touched is 140. We budgeted is 150. We budgeted 140. Now the sales are given, and other direct materials, their costs are given. But before we go ahead, they said we should, the question is that we should prepare an operating statement reconciling the budget profit with the actual profit. We need to know the actual profit. We need to know the actual profit. We need to know the actual profit, which is what we will call the unadjusted profit. Then we need to know the budgeted profit. Now, the standard profit can be said to be the budgeted, but it must be in total. Don't forget that I told you that the budgeted is always in total. So the standard is always in unit. So we got a unit standard profit here as 1,000, and the budgeted or the standard roofing or budgeted roofing is 140. So it means that we should be looking for a budgeted profit of 140 times 1,000 naira. I mean, 140 roof times 1,000 naira. So our budgeted profit is equals to 140 times 1,000, which means we are looking for, we budgeted that we will make 140,000 profit. You can call that working one, working two. The actual expected profit. What we will do is that we will flex it to the actual quantity. We will flex it to the actual quantity per se. So if we are flexing it, we are giving the sales. What's the sales? 800 and what? 864,000. Pardon? Now, the quantity that we, the actual quantity is that cost of sales. What it means is that what should be absorbed, that is 150 times, what's the cost? Budgeted cost or standard cost is 5,000 in the equation. Abi? It's 5,000 in the equation. So our expected profit should be 150 times 5,000, that's 750. You minus it, you have 0.00411. So this is our expected actual profit. We go by the standard cost, because we are asked to prepare an operating statement. So reconciling the budgeted profit with the actual profit. This is the actual profit we are expecting. You can see there is a difference between 140 budgeted and the actual profit expected, which is about six negative. It's adverse. 36,000 is negative. It's negative. So the direct material variance, we will direct material variance. We have done the sales variance by getting the expected profit. Abi, are we there? Madam Esther, thank you for joining us. You are welcome for joining us. We will make the standard cost will be flexed with the actual quantity. Then we will minus it from the actual cost. So having done the sales, we want to look at cost. So we are starting with the first cost variance. We are starting with the cost variance or the variable production cost variance. We will do admin, but they are always in total. Admin is in total. Admin sales is in total. Sales overhead, admin overhead. You know they are part of the cost variance, but we will do them because they came down. Let's start with variable direct. The direct material is you reflect it with the actual quantity. What is the actual quantity of the direct material? The actual quantity of direct material. The actual. That is the actual quantity purchased, not used. The actual quantity purchased for the project is in the question. That is 360 tons. I mean, that is 360 tons.
Yes.
So what is our standard price? That's the selling price. Figure. the standard price per ton direct material.
$800. 800. Okay, it's like 2 tons at 400 naira each, which is 800.
So it's 400. For one is 400 naira. The direct material for one is 400 naira. That is what we budgeted. So the standard cost will be 360 is what we purchased, actual. 360 times 400 bracket minus the actual amount sold is how much? It's in the actual this thing. 360 was the actual amount we bought. Sorry, actual amount bought. The actual amount of the 360.
48,000.
133.
133,200. 133,200. What's the difference? What's the difference?
That's 1,800.
10,800. This is price. This is direct material price variance. 10,000. Favorable or adverse? Now, how do you know whether it is favorable or adverse? The way to know is by looking at it this way. We plan to buy we plan to buy 360 times 400, but we bought above that, because 360 times 400 will give us what?
144,000.
144,000. So we said we will buy 144,000. We ended up buying 133,200. Is it favorable?
Yes.
Is it favorable or adverse?
Yes. Favorable.
Favorable. So what we got, the price variance is favorable to us. So it's F. We put F there. The B part, usage. So this one will, the formula for this one will be, for A will be standard cost minus, it doesn't matter where standard or actual is, so it doesn't really matter. Standard cost minus actual cost multiplied by actual quantity. Standard cost minus actual cost per unit multiplied by the actual quantity purchased. Actual quantity purchased. That will give us the price variance. So if you look at our, if you divide 133,200 by what's it called? 360, you will get the actual cost. You will see that it is lower than 400 naira. I didn't want to go like that first. I just wanted you to get the answer first before you now start looking at it piecemeal. Before you look at it piecemeal. Are you following me?
Yes.
Now, usage variance, which is the other leg of direct material. That would be standard usage minus the actual usage multiplied by the standard cost. Standard usage quantity. Standard, I will write it on the board. Standard usage based on actual quantity. Standard usage based on actual quantity produced or sold minus actual quantity. Anytime you are dealing with quantity, you multiply with standard price. Anytime you are dealing with price, you multiply with actual quantity. If you look at the price here, standard price or direct material cost, which is price per unit, actual price, which is something as cost. So I can substitute this C for P. Standard cost is the same thing as standard price per unit. I can substitute the standard cost. I'm not looking at the total this time, I'm looking at per unit. Standard cost minus actual price, which is the same thing. Price, cost. I'm saying the same thing. It's a matter of semantics. Now, anytime you have price, what you multiply it with is the actual quantity. But when you are dealing with quantity, you multiply with standard price. It works for every situation. Standard costing, except very few, and we will get there when we talk about budget. and all the rest. We'll get there. We'll talk about them in this question. So, what is the standard quantity based on actual quantity sold? The standard quantity of material is 2 tons. Abi? The standard quantity is 2 tons. Times what's the actual quantity sold or produced, 150. Minus what's the actual quantity used. Actual quantity used is in the actual side of it. Actual quantity used. Figure. Actual quantity used. Figure.
48,000. No, that's
Mm-mm.
340.
Per unit. 340. 340 tons. What's the standard price? Times 400. You have established the standard price somewhere. Yeah. Figure.
Mm. 400
Figure. 40 times 400.
16,000.
2 times 1 is 300. 300 minus 340 is 400. 4 is 40. 40 times price 400. You know that?
16,000.
16,000. Adverse or favorable?
Advance.
Why?
We budgeted that.
Why is it adverse?
Sir?
Why is it adverse? Madam Odupe said it's adverse.
Higher than the actual.
Which one is higher than the actual?
The standard. I think the standard is.
No, now the standard is 300. The actual is 340. How did the standard now? The standard is not higher than
The actual.
It's not higher than
They used more. The standard is lower than the actual. They used more of
No, I disagree.
what they projected.
They use more of.
Or their budgeted plan, their budgeted estimate.
Now, they use more material than what they planned, than the standard. Agreed. It means there was inefficiency. Don't forget that they told us to interpret all these things. The question said we should interpret. The question said we should interpret. They use more material, 40 tons, than they planned, than the standard of 300 tons. So there's an adverse effect. The difference is adverse because there were inefficiency or wastage. or probably they use unskilled labor for quality materials, and they wasted it. These are the interpretation why we have an adverse. Having used more material, they wasted the material somehow. There is a good attempt anyway. Thank you. Now, having done with material, we have to go to labor. You have to go to labor. Let's look at the first branch. What's the first branch there? Well, let's start with rate. Let's start with rate. When we talk about rate, that's price. That will be standard rate based on actual hour worked. Because actual hour work is always the standard, it's always the quantity. Actual hour worked is like quantity. When we talk about services, we are looking at hours, and our services is always the level of activity. Are you following me? So if our services is level of activity, because we are producing goods and services in manufacturing company, and we are looking at manufacturing company in MA, so definitely we'll be talking, when we talk about service, we'll talk about hours, because hour worked is the quantity of work we give, and that is the hour worked. Now, the formula, can I clean the top?
Yes.
Direct labor. That's number 4. Direct labor rate. That would be standard price or wage based on what? Actual hour worked. Minus actual hour worked. I told you when it is price, it will be standard rate. Abi, it will be standard rate multiplied by standard rate. Is it standard rate? When we talk about price, what are we talking about? Sorry, actual hour worked is quantity. Actual hour worked, that is actual quantity worked. Actual hour worked. That would be the formula. Is that also? That's for rate.
Yeah.
That's for rate. Now, what is the actual hour work? Is given in the question. Direct labor, actual hour, 52,000 hours. 52,000 hours. That would be 52,000 hours What is the standard rate per hour? Is still in the question. Look at the standard. Look at the standard cost estimate that is given at the beginning of the question. They said 5 naira per hour. Abi? 5 naira per hour. So that would be the standard price or rate sorry, it's actual rate too. Sorry, not actual hour. We are looking at rate. Standard rate minus actual hour, but it will be based on actual hour work. So the standard rate is 5 naira. The standard rate is 5 naira times what's the actual hour we determine 52,000 minus actual hour in that question they paid is 288,000. I mean, there's no need looking for the price, the individual price, by dividing the 288 by the actual hour to get the actual and then. So what's the figure? 5 times 52 minus 288. Figure.
28,000.
Eh?
28,000.
28,000. 28,000 naira. Now, is it adverse or favorable? We budgeted or planned this amount, but we paid more. Or is it more? More, yes, we paid more. 288. We paid more.
Adverse.
Adverse, Abi. Adverse. We paid more than we planned to pay. We paid wages more than we planned to pay. It's adverse. It's adverse. We paid more. That is, we had idle time. We had idle time. We paid for idle time. We paid for idle time. They were going to toilet often, or they were not skilled enough. That is even what affected our material usage. Our material usage. We had advice in our material usage, while in the material itself, we had favorable. The material price, we had favorable. But when they were using it, they didn't use it professionally, because they were gisting most times instead of working. The next that we are going to look at is the idle time variance under labor. idle time variance. And that is hour. The difference between actual hour worked and the budgeted. And this is B. We have C. Standard hour minus actual hour. I say when it is quantity, you multiply by price, Abi, standard rate. Standard rate. Standard rate. Are we there? What is the standard hour that we planned that they should work? It's in the question.
$380.
So we are looking at idle time.
Oh, idle
We are
time.
looking at idle time. So what is idle time? Idle time variance. That will be idle time multiplied by standard rate. So what's the idle time in that question?
8,000.
8,000. 8,000. 8,000. So it will be 8,000 times standard rate is what? 5, Abi? That one is simple and straightforward. That will be 8,000 times 5. That should be 40. 40,000. Idle time is always adverse because it's a negative event. It's a negative occurrence. So it should always be negative. That's adverse. Are we there?
Yes, sir.
The C part, which is efficiency variance. That will be standard hour work based on actual, quantity minus actual hour work times standard price. What is standard rate? What's the standard rate?
₦5.
Standard rate. So the actual hour work, the standard hour work based on actual quantity. Standard hour work is in the question, I think it's 300 hours. 300 hours is planned times 150 roof that was produced minus what's the actual hour worked?
44.
It's in the question, I think it's 44,000. Hour worked active time 44,000. 44,000 hours multiplied by what? 5, which is standard rate. So this one will give us what? 150 times 300, 45,000 minus this 1,000 remaining times 5 equals to 5,000. Favorable or adverse? They plan to work 45,000 hours. They eventually worked 44,000. So it should be favorable. Should be favorable. They are used to the material. Because they are used to the material, the efficiency came in. They were efficient. You know, when you constantly use a material, you become proficient in it. And at the end of the day, you produce more results. One of the reasons why they were able to produce 150 roofs, that's roofs. Because they were efficient. Now, don't forget that I told you if you add all the variance for efficiency, idle time, and rate, you will get the total variance of the direct labor. So what it means is that we have 40,000 adverse, 28,000 adverse. That will give us 68,000 adverse. If you add the favorable of 5,000, you have 63 adverse. The total labor cost will be 63,000 adverse. So which cost again are we looking at?
What did we just calculate?
Which cost again are we looking at?
What did we just calculate now? I didn't get it.
That's what we can need.
Now, when you say we should add the direct labor rates, idle time and efficiency, what are we calculating?
Wow.